everyone. I'm Brandon Garrett of Ben Oak Capital with our May 2022 market update. Please stay tuned at the end of this video for a required disclosure statement. 2022 has been a challenging year for investors so far. The S&P 500 index just had one of its worst Aprils in decades, and May is off to a rocky start. Bond investors have not fared much better as rising interest rates have pushed down bond prices. Bond losses have made the stock market volatility feel even worse than usual. Markets don't like uncertainty, but it's getting a healthy dose of it this year, dealing with high inflation, tighter Federal Reserve policy, COVID-19 shutdowns in China, and global supply chain issues, all while the war in Ukraine continues. It's important to know that investing mistakes often take place during periods of elevated volatility. One of the most frequent is trying to time the market by jumping in and out. Market timers must be right twice, and timing the return to the market can be extremely difficult to pull off and nearly impossible to do consistently. Markets can turn quickly, and missing even just one big up day can significantly reduce returns over time. The biggest daily gains tend to come in down markets, making them especially difficult to predict. Time in the market, not timing the market, may be more beneficial to long-term investors. We believe it makes more sense to make incremental portfolio changes following a quantitative process rather than making drastic allocation changes in the heat of the moment. When markets are shaky, it can be helpful to look to long-term fundamentals that have provided the foundation of positive returns for stocks and bonds over the long run. For stocks, gains depend on the ability of corporations to grow earnings, which they have continued to do during the first quarter earnings season. S&P 500 index earnings per share are on track to increase 10% year over year, and coupled with lower stock prices, this makes price-to-earnings ratios and other valuations fundamentally solid at these levels from a long-term perspective. For bonds, the key fundamental has simply been the ability for borrowers to make required payments. Corporations and consumers alike enjoy strong balance sheets and have the financial firepower to pay their debts. While the future is always uncertain, we believe those fundamentals remain in place. Even against a potentially supportive fundamental backdrop, the volatility we've seen in stocks this year is not unusual. Although negative returns for a full calendar year are infrequent, corrections are fairly common. Since 1980, the S&P 500 has been negative for a calendar year just 7 times, but the average decline within any year has been 14%. Midterm election years have tended to see increased early year volatility, and inflation can also be challenging. Years with inflation over 5% have seen more frequent stock market declines than a typical year, but stocks have still been higher more often than not. Amid the global economic and geopolitical uncertainty, the core domestic economy is still quite stable. Weekly consumer spending data is above typical baseline levels. Job seekers are participating in a tight labor market with twice as many openings as unemployed people. Businesses are enjoying high profit margins despite cost pressures. Take a look at this chart and pay attention to those red X's. These are market levels where investors likely felt the most anxiety. Now ask yourself, if you were to buy into the stock market, where would you want to do it? Or, more importantly, if you wanted to sell your stocks, where would you not want to do it? I imagine your answer to both of those questions would be the red X's. We believe patient investors stand a better chance of meeting their long-term goals. No one has a crystal ball, but at lower valuations, history suggests the chances of above-average returns going forward may be rising. It's tough to do during times like this, but we encourage long-term investors to stick to the game plan. That's it for this month's video, but be on the lookout for additional market and volatility-related resources, including webinars and blog posts. We are committed to helping you through all market environments, and if you have any questions or would like to revisit your financial plan, please give us a call.